Cash is fading. Screens are winning. And every tap moves power from one part of the system to another. So who gains, who loses, and what kind of money world are we drifting into? Let's follow the rails, not the rumors. 1. Big picture. Across many advanced economies, cash use has dropped by roughly 1/3 since 2020. Not exact numbers, but directionally right, and central banks agree. Digital payments are growing in double digits yearly. Tap to pay, mobile wallets, instant transfers, QR codes. The geography changes, but the trend doesn't. Sweden's near cashless. Germany still loves paper. The UK, US, Korea, Singapore, moving fast. Governments like digital because it's traceable. It tightens tax collection, cuts fraud, and speeds up public payments. So the shift is not only about convenience. It's about visibility, power, and who controls access to the financial system. 2. How we got here. First came cards, trust at a distance. Then online banking and e-commerce turned digital payment into a basic expectation. Then came mobile. Tapping a phone became as natural as grabbing keys. COVID accelerated everything. Merchants pushed tap or scan. Consumers learned speed, refunds, and digital receipts. Behind the scenes, payment processors, card networks, and real-time rails stitched the plumbing together. Most people don't see these rails. But they decide fees, speed, and who sits in the middle of each transaction. And with QR codes and instant transfers? Cards aren't even required. Money jumps from account to account. Business models shift. Fees shift. Power shifts. 3. Governments and control. Governments like digital trails because they shrink the informal economy. It's simple. What's recorded gets taxed. More than 100 countries are exploring or piloting central bank digital currencies, CBDCs. Some want to modernize wholesale settlements. Others want a retail public option for money. Digital money increases traceability. Transfers leave logs. Limits and thresholds can be automated. Cash is different. Cash is private. Cash settles with no intermediary. So the trade-off is real. Traceability helps catch fraud. Privacy protects autonomy. The right balance depends on policy, not technology. 4. Winners in a cashless world. Banks win. Every tap is a small toll, and volume compounds. Payment processors and fintechs win by orchestrating the complexity, fraud tools routing, subscriptions, APIs. Their mode is convenience. Big tech wins by embedding payments inside ecosystems. Apple Pay, Google Pay, super apps. The wallet strengthens the platform. The platform strengthens the wallet. Governments win through cleaner tax data and faster benefits delivery. Retailers win when cash handling shrinks. Self-checkout, in-app orders, unattended kiosks, they all rely on digital rails. In simple terms, whoever controls the point where intent becomes payment, takes a cut, and takes the data. 5. Losers in a cashless world. The informal economy loses breathing room. Side gigs become visible. Cash-paid workers face new compliance burdens. Elderly and rural communities struggle with smartphones and weak networks. Small shops used to cash drawers must now manage terminals, chargebacks, and settlement timing. Some adapt, some don't. Privacy advocates worry about surveillance, state and corporate. Metadata reveals patterns even without reading a single message. And people living paycheck to paycheck face new frictions. Transfer fees, instant payment limits. Subscription creep hiding in app stores. Efficiency for the median can still mean exclusion at the margins. 6. CBDCs, the next battle. A CBDC is just digital money issued by a central bank, like physical cash, but programmable. Two models exist. Wholesale, used by banks to settle big payments. Retail, a digital version of cash for daily use. Potential benefits: faster transfers, better inclusion, resilience during crises, cheaper cross-border flows. But risks exist too. If transaction data concentrates in the wrong place, privacy erodes. If features are over-programmable, spending limits could be misused. If deposits move into CBDCs during stress, banks face liquidity drains. Design matters. Intermediated models let banks handle accounts and privacy layers. Balance caps prevent bank runs. Offline modes keep systems alive during outages. Geopolitics is in play. China has large-scale pilots. Europe is designing a digital euro. The US debates whether a retail CBDC is even desirable. CBDCs can modernize the rails, or over-centralize them. The architecture is the policy. 7. What it means for consumers. Payments become instant, refunds too. Delayed transfers will feel prehistoric. Cash handling risks disappear. No lost envelopes, no counting errors. But digital exposure grows. Scams target the same wallet that pays rent. Outages matter because everything routes through a few platforms. Fees hide in interfaces. And budgeting changes. Cash envelopes had friction you could feel. Digital money needs intentional structure, subaccounts, alerts, and rules. 8. Winners and losers. Winners: banks, processors, fintech platforms, big tech ecosystems, governments, retailers that automate. Losers: cash-reliant workers, small cash-heavy businesses, people in rural or low connectivity areas, anyone who values anonymity by default. Efficiency up, friction down. Privacy depends on policy. Cash is dying. Digital money is rising. The question isn't whether payments will be fast, they already are. The real question is who will own the rails, the data, and the kill switch. Stay curious, stay sharp.